In the first 8 episodes, I discussed how to analyze the budget. Now, let us see how the budget fared based on the things I told in those episodes. Hi, my name is Swapnil, and this is the ninth episode of Budget Analysis series. For any economist, the most important number is fiscal deficit. In the last year's budget, the government projected 6.4% as FY23's fiscal deficit in budgeted estimates. Now, as per the revised estimates of FY23, the government has kept it unchanged. How did it manage to keep the fiscal deficit same? All the items, nominal GDP, receipts, expenditure, and fiscal deficit have increased by around 6% as per revised estimates compared to the budgeted estimates for FY23. Corporate tax and income tax revenue were very high compared to the earlier estimates. At the same time, subsidies also rose due to Russia-Ukraine situation. The government had to therefore control its revenue expenditure and decrease its capital expenditure. So, what has happened is that by attaining higher GDP and receipts, the government could spend more on subsidies but had to control all its other expenses. That's how it could control the fiscal deficit. Government releases another document explaining the difference between budgeted estimates for FY23 and revised estimates for FY23. But it is equally smart to not give full disclosure on your plate directly. Since total expenditure has increased, it has only mentioned the items where expenditure has increased. Obviously, there would be some items where the expenditure was reduced, like capital expenditure. It has not given those details in this document. Now, for FY24, the fiscal deficit is estimated to be 5.9%. Again, the same question, how it is going to achieve it. Here, we have to compare FY24 budgeted estimates with FY23 revised estimates. The government estimated its receipts to grow by 12%, expenditure by 8%, fiscal deficit by 2%, and nominal GDP by 11%. Since receipts are growing at a higher percentage than expenditure, it is highly likely that the government can attain this target. It is also a good thing that it is trying to reduce the fiscal deficit. It has also said that it will bring it down below 4.5% of GDP by 2026. So this is also a great sign. We must also look whether the growth percentages are in line with each other. Here the receipts and GDP growth rates are in line with each other, which is also a fair assumption. Again, a plus point for the government. The government plans to spend more on capex by increasing it by 37%, which is a huge thing. But it is going to keep revenue expenditure around the same level. How that is going to happen? It will be reducing subsidies by 28%. At the same time, it is also going to reduce its allocation to rural economy, primarily by reducing the Manrega allocations. This is a bit tricky, I feel, given how Manrega functions in India. Whenever there is a stress in a rural economy or labor markets in urban areas, the government has to increase Manrega allocations from time to time. Also, in case global food and fertilizer issues get entrenched, then the government would be under pressure to increase subsidies. And we know how sensitive current geopolitical situation is. So these, I believe, are the risky areas. All in all, fiscal discipline is maintained and it seems that it will be maintained properly going ahead. That is a very good sign. That's it for this episode. Follow me for more updates on budget and economy. Thank you.